And then there's like the really negative scenario, which center around the Strait of Hormuz. As much as 20% of world production of both oil and gas passes through the Strait of Hormuz. If the Straits of Hormuz are effectively closed for a prolonged period of time, that can create some much larger disruptions. And then you start having like real problems that could actually snowball into a proper recession and real spikes in inflation of the likes that we remember from COVID.
You're listening to the Financers Podcast.
1, 2, 3, listen.
All right, welcome to another quarterly update with JT from InvestSense. We'll obviously talk about a little bit around our SMA and our client portfolios, but probably a very timely catch up with recent events over the last week in the macro space and in the global economy and everyone. So welcome JT, and we'll obviously run through. We'll get it off the bat early and talk about Iran and the current conflict, and then we'll talk about it at AI and tech updates and a couple of little stock stories around that as well. So welcome to another catch up.
Thank you, Ben, and thanks for having me again.
Pleasure. So give us the good news, bad news, or everything in between. What's the sort of current state of play for the Iran situation?
Yeah, sure. Look, obviously, we don't have any non-public information. A lot of it is speculative. No one really knows how this thing is going to develop. But as you know, our general approach is we build portfolios based on fundamentals, and that's kind of our guiding, our North Star, if you will. And then obviously there are things like geopolitics, like flow of funds and liquidity that come into play, and that we have to deal with on the more short-term basis without keeping track of the long-term objectives, right? Now, when it comes to Iran and more generally on geopolitical developments, the way we try to tackle it is let's identify all the various scenarios, and importantly, identify the market impact. Now, generally speaking, I say the tendency is to overplay the geopolitics, and in more cases than not, the geopolitics don't have that much market impact, especially over the medium to long term, right? But the idea is let's identify all the scenarios, put some probability around it, but understanding that it's mostly like a finger in the wind sort of the exercise, and then really understand what's priced in and what's not priced in, and that's probably where we can identify if there's risk in the portfolio that we weren't necessarily aware of, or actually opportunities in the portfolio elsewhere. So that's the thesis. Let's apply that to the conflict in Iran. The base case scenario, which we'll assign, let's say, for the sake of argument, for 40% probability or something like that, is that this is a relatively contained conflict in time, and in terms of the its spread, right? So it really is contained to U.S. and Israel on one side versus Iran, and the U.S. has been very clear on their intention that there will not be boots on the ground. That it's an aerial campaign that is designed to last weeks but not months, right? Now, understanding that things can evolve and won't necessarily stick to that, but that is our base case scenario. In that scenario, it is likely that the price of oil goes up. It's already up to somewhere around $80. And it can go up to somewhere $90, $100, still within that scenario. That is a momentary spike in price of oil that can last a few months before it normalizes again. There are some impacts of this scenario primarily on the price of energy feeds into inflation. So you increase the cost of energy, and you increase the cost of anything that requires energy, which is pretty much everything. And there are quite handy models from the International Monetary Fund or a few central banks that model the impact of oil price increase on inflation and on growth. And typically speaking, you have a spike in price of energy causes a spike in inflation and a downgrade of growth expectations, right? So you have kind of like a little bit of what's called a stagflationary scenario shaping up, less growth, more inflation, which can be pretty negative for markets, right? The key is that in our base case scenario, this is fairly limited, right? We'll have inflation going up by a maximum 1% relative to current expectations, only for the next year, and then reducing after that, and growth falling by less than 1%. Over. So it's not no impact at all, but it's relatively contained. Then there's a lesser likelihood scenario that even this is actually too aggressive in a way, that we won't see that much. That'd be a much shorter conflict with much shorter impact. And then there's like the really negative scenario, which center around the Strait of Hormuz, which you may have read about. As much as 20% of world production of both oil and gas passes through the Strait of Hormuz. If the Straits of Hormuz are effectively closed for a prolonged period of time, that can create some much larger disruptions, primarily to the price of energy. And then you have all the same effects, but amplified. And then you start having like real problems that could actually snowball into a proper recession, and real spikes in inflation of the likes that we remember from COVID, right? So that's the less likely scenario, but still possible. How do we play that within the portfolios? As you know, to date, we haven't made any changes. We think on the inflation side, inflation has an impact on both the bonds and the equities part of the portfolio, right? When it comes to the bonds, we have an exposure to duration or to change in interest rates that is relatively middle of the ground, right? Not as much as the index, but not down to zero. We think we're fairly well positioned if even if inflation increases by a little bit. And on the equity side we have been positioned for quite some time away from most of the very expensive, highly valued stocks that are more sensitive to changes in inflation and interest rates. So again, I think we're fairly well positioned for that. That saying, and I'll stop here because again I've been talking for too long, is that we are exposed to market, and particularly to short-term volatility. And so if things happen in markets like they happened yesterday, we were reporting this on the 5th of March. The 4th of March was a particularly volatile day for markets. We were definitely exposed to that. But for now, we can still categorize that as like short-term noise and waiting to see how it will play out.
And I think also relative to the performance over the recent 12-month period, like it is only a small pullback in that overall performance as well. And I think, as you said, like where I think from a strategic point of view, the portfolios we've continued to trim profit and remove exposure to where there has been really good growth stories, means that when you do have these hiccups, that you don't feel that pain almost twice as much. And especially with some of the tech sector and AI stuff, there's been a bit of a pullback and a bit of some challenges in recent times also. But you see that with basically any investment, is it will go really well, and then at the slight little bit of bad news, and it might not even directly relate to it, then quickly sentiment swings hard back the other way. And it might only be temporary, but you can see it was interesting. I thought as the week played out, Monday wasn't too bad, Tuesday wasn't too bad, and Wednesday was sort of like it got a little bit worse, and then I think today we're back in the green again. But it's interesting. I think a lot of people expected, and not that we've had many clients really questioning or concerned, they're expecting a complete bloodbath on Monday, Tuesday, and instead, I think, in a way, I think a client might have said to me best is it was sort of desensitized to an extent of these issues, because there's been just so many different things happening in recent years, and people sort of learning the lesson to not be too reactive, which is good. But there's also still potential for some opportunities. There's potential for some pain. But obviously we just have to ride through that. And maybe again, people sort of, the surface level reaction is to pile into, I don't know, oil stocks and things like that. And I think, when we look at the direct portfolio, Woodside's probably the clear name that's in there. There's obviously some other indirect exposures too, but maybe just to comment on Woodside broadly, and I suppose it was in the portfolio already, but maybe why was it in there to start with, more so than what is it doing right now?
Yeah, sure. Glad you brought that up. That is definitely our most direct exposure to the current situation. And yeah, look, the thesis originally was, generally speaking, energy companies are relatively attractively priced. And if you compare Woodside to some of the energy majors, the likes of British Petroleum and Total, ExxonMobil, etc., you'll see that Woodside is actually trading at a discount to all of them, right? So the sector as a whole is relatively cheap, but Woodside is particularly trading at a discount to the rest, and it doesn't seem that that discount is backed by strong fundamentals. There's nothing particularly weak about Woodside that would justify this, and hence why we've generally been overweight Woodside for quite some time. So very important that our thesis with Woodside was not based on an escalation in the Middle East and was not based on the price of oil going up, right? Like we think Woodside, even at oil prices around 60, somewhere between 60 and $70, should be worth more than what it was trading at. Now, definitely what's transpired over the last few days is helpful, right? It's helpful for the price of oil, and you see the reaction immediately in the price of Woodside. If if we're going with the scenario 2, which is the conflict is actually shorter and has less impact than what's currently anticipated, then you should see Woodside fall back to where it was before the conflict. And then there's not necessarily a short-term gain that we want to take advantage of here. It's more kind of the long-term play, and Woodside would continue to be attractively priced at that level. If it's the second scenario, if it's the first or even the third scenario, then there's more upside to Woodside, and then maybe at some point it's a situation where we can take some profits on it if the price of oil really spikes.
Yeah, I suppose the key thing is it's not overplaying that exposure, is it? Like, it's there for a reason. It may go up, it may drop back, but ultimately it's not a position that we're playing around with and trying to sort of out finesse and outsmart ourselves. Like, it's there for a whole range of reasons. It's not like we're trying to jump in quickly and make a quick dollar and get out again, which is generally not our approach in any investment. So
Absolutely.
the fundamentals stack up still. There's probably, again, it's an indirect exposure, or sorry, indirect risk for most things, is where inflation increases, and that does have a flow on. Like, that's a broader market pullback and a broader economic pullback, isn't it? Rather than any direct stock that we hold or investment that we hold that you go, well, that one's really at risk if this thing blows up. I think everything's at risk if it obviously blows up, but also within reason. There's a lot of businesses that will, be positioned okay to deal with it. I suppose to summarize, and again, jump in if this is incorrect, but we just have to be aware at this point. Like, we don't need to be trying to change things around. We're just aware, we're monitoring things. As probably the market is to an extent. Like, that's what we're sort of seeing, is it's the market hasn't got too much conviction one way or the other. People aren't too sure if this blows over or blows up. So we'll continue to do the same. I think when I talk to clients, we've taken profit a lot of times in the last sort of 12 months off the top. So we're well positioned that we haven't been overexposed. That wasn't reading. You can claim that you thought you knew this was going to happen, but it was more so just letting the data and letting our systems and processes, drive those decisions, which is what we want to do all the time, and we stick to that.
Absolutely. And a great example of that is something you haven't talked about yet, which is gold, right? Like, we had a fairly large exposure to gold. Gold usually appreciates when uncertainty and volatility accelerates. We took profits on our gold position earlier in the year, I think in February, but before that the conflict started. And it was really just a matter of portfolio construction, diversification, and taking profits when a position is done well, and you want to kind of appropriately manage the risk associated with it, right? As it happened during this the conflict with Iran, gold initially went up and actually went back down quite a lot yesterday, right? And so though the assets can behave in ways that are a little bit unexpected, and to your point, we really shouldn't be trying to trade that on a day-to-day. Follow the process. We were able to take profits on gold, and it puts us in a better position today.
Maybe just jumping off that onto just another topic before we wrap up, and just around the AI and tech side of things. Obviously, that sort of probably had been the theme until the last week. So maybe just some feedback and commentary around what we're seeing in that market space. I know it's very topical for people in businesses, in AI and general life. So what are we seeing happening in a market sense for that?
Yeah, look. I think this is really the question, the big unknown of this year, and probably of the next few years. So I think in terms of the Iran situation is likely to blow over in a few weeks. This is the question around AI and its impact on company earnings is going to be with us for a while. So just to summarize what's happening is the capabilities of the AI models to code have accelerated significantly in the last 6 months, and to the point where they can completely replace coders, developers, and obviously work a lot faster and better. Now that poses a problem for companies whose main business is a software, because you can get ChatGPT or Claude or Gemini to create a piece of software for you, even relatively complicated ones. So let's use an example. Xero, which is an accounting software company listed here in Australia. Originally, I think a New Zealand company, but it has a fairly large market in the US. A very good accounting software, very appreciated by a lot of business who use it. Why did the market value Xero so highly, right? Xero has been expensive for quite some time. Well, because number one, it's a capital light system. It doesn't require a lot of capital expenditure. You don't need to build factories, big factories, right? You just need computers and a few developers. And so that means that business is going to have low debt, right? The second aspect of it is that it works as a SaaS, what's called a software as a service, and it's a recurring type of revenue, right? So you don't just buy the software once, you pay it as a subscription. And that means that its revenue profile is very stable. And it tends to be that once you implement a software like that in your business, it becomes quite hard to pull the plug on it because it's ingrained in your systems and your operating flow, and therefore it's quite sticky. So sticky, stable revenue, and it's a good product, so it's growing and it's got high margin and no debt, right? Like it's nirvana for investors, and hence why the market was willing to pay quite a high multiple for it, because it has all of those qualities. Here comes AI and the threat of AI, and basically anybody can replicate Xero at a fraction of the cost, right? And either you and I can do it for our own businesses, or 2 or 3 clever engineers can do that and offer it as a competitor to Xero at really a fraction of the subscription price that it costs, right? Either way, the revenue profile of Xero looks a lot less attractive now. So that was one example, but you extend that to a whole lot of companies, primarily in the software space, but not just, right? It's the same with the likes of car sales and Seeks, all of those companies where essentially instead of going to their website, you can just go to ChatGPT and ask them to find you a job or a car for sale, etc., and it will scour the internet and find the best fit for you. It's also the case for an insurance broker, right? Instead of going directly to the insurance broker and ask ChatGPT to find you to compare all the different insurance policies, and so there's quite a lot of companies' business models that are now at threat. And as I said, that threat is serious. Within that, it is way too early to know whether the market has fully priced the risk, or if there's more downside to go, or if the risk has been exaggerated in certain cases, as I'm sure is the case, right? And so this is by far, I'm maybe not providing answers here, I'm just explaining the problem, but this is by far the biggest question that we have to face. It touches on a lot of different sectors and industries, not just in tech, and it's really the question of our day, and we don't really have an answer. So this is a situation that we currently not just monitoring, but doing a lot of research on, and hopefully trying to find opportunities one way or another.
It's interesting when you look at it, like I think people expecting that almost you can, some people expecting you just get anything tech, anything software based, and those stocks will do well. In an actual sense, is that the AI revolution may actually just cannibalize itself and eat each other up, because it can quickly make each other redundant in a sense. Like if you use Xero as the example, is that there's lots of other businesses out there, like some of the ones you mentioned, that are fully reliant on that sort of data processing and that system of collation, which has now become very much an automated process. Like that just doesn't require the level of people and time and expense. And ultimately, people will, at a point, move with their dollars. Like they will follow the cheapest solution or things that they can integrate better into their world. And we see it little bit by bit with different things, and we all interact with them and probably don't even realize they're AI or that tech solution based. And I think, as you said, everyone's a little bit cautious around what that looks like in terms of jobs and reallocation of capital and things over time. So it's something that we need to be conscious of and aware of. And clients often ask, "Oh, what are we buying in the AI space?" Well, there's always going to be exposure to it, but I think often that way that we've been exposed, I often say them sort of one step removed, is through energy and through a lot of those secondaries that are going to be used no matter what. Like they're going to need power and they're going to need data centers and things, no matter whether it's Xero's the business who's doing it or it's someone else. So sometimes you're better to be a little bit, one step removed from that and protected, but try and still find the tailwinds. And I think it's been effective so far.
Yeah, no, absolutely. And look, I think that, as you mentioned, I think that we have to acknowledge that, there's the primary question. There's a lot of like flow-on effects, particularly around unemployment, and that feeds into consumption, which really touches on everyone and everything. So there are really deep questions. There are, some winners from that, obviously, right? Healthcare companies could be biggest winners of, they could develop through AIs, they could develop medicines a lot faster. There are industries that are completely isolated or could have in benefit for, energy companies, as you mentioned, defense companies in a way, and the key is that we don't really know, right? We don't really have all the answers. And therefore, our strategy of being very diversified, and not putting all eggs in one basket, at every level and at every, asset class within the portfolio, and two, let the valuation be our guide, right? Like the main reason we didn't own Xero in our portfolio. Now, I say that we own other companies that have been impacted, etc. Right? So I'm not saying we have a perfect 2020 vision here, but the main reason we didn't own Xero is that we found it was too expensive, right? And we didn't consider the AI threat in that. It was just you've been asked to pay a very high price. What happens in an expensive company is it's more at risk of a catalyst coming and disturbing the story, because the fall will be bigger because it's gone up higher, basically. And I think
similar to what we were talking about earlier, is that where it's gone ahead quickly, like a small hurdle can become a big one, and when you have a really significant one, it can become a catastrophic one for it. And that's where using those fundamentals, always going back to the process around PEs and those things, is really crucial. Like it's the simple stuff.
Exactly. Like the valuation methodology both helps with long-term expected return, but also with reducing risk. And that's the second aspect that we've seen happening more recently.
I think we might need to jump on again in the next few weeks. We'll see what the world brings. We'll be able to come back and listen in and see how your predictions were. But,
hopefully, I didn't make a prediction. That was the goal.
No, I think you sat on the fence really well. But I think that's in some ways that's our superpower, is just sitting on the fence and actually having having strategic balance between things. I think that's the key thing from a client perspective. When we talk about households, it's just about not being too exposed in any one area of their life or their finances, and then we flow that through to the portfolios, and we get consistent returns and consistent outcomes from that. So obviously we have to be aware of these issues like Iran and AI stuff and just the tech changes, and then the specific companies that we need to be investing in, whether it's oil or gas or whatever it may be. Again, always love to get the updates, and no doubt we'll keep talking about gold every quarter like we have for the last few years. It was a bit boring before that, but now it's been interesting. So thank you as always. And anyone with any questions out there, I know there's probably a time where there's likely to be more questions. Please fire them through. We can get responses out to anyone who has any. So thanks, JT.
Thank you, Ben.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, YouTube, and Twitter @BurkeBrittonFP, or Google Burke Britton Financial Partners to check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening. Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decisions, listeners should consider the appropriateness of any information with regard to their particular objective, situation, or needs, and seek advice from a licensed professional specific to their circumstances. PB Financial Solutions Proprietary Limited, trading as Burke Britain Financial Partners, are authorised representatives of Acumen Financial Planning, ABN 89051 208 327, Australian Financial Services Licence 232706.